Hey there, everyone. If you're keeping up with the latest news, or even just chatting with your neighbor, you've probably heard that mortgage rates in 2024 are a big deal. Whether you're a first-time buyer, looking to refinance, or trying to stay on top of rising costs, things are intense out there. Today's video breaks down what's driving these mortgage rates up, what it means for regular folks like you and me, and how you can stay ahead of the curve. So, let's start with the basics. 2024 mortgage rates are the highest we've seen in over a decade. The 30-year fixed-rate mortgage is hovering around 7–8%, more than double what it was just a few years ago in 2021, when rates were around 3%. What's going on? It all comes back to the Federal Reserve. The Fed has been raising interest rates to combat inflation, making borrowing more expensive so people spend less, which in theory, helps cool things down. But the side effect? Higher rates for home loans. It's a tough pill to swallow if you're looking to buy or refinance right now. This brings us to the big question: what does this mean for home buyers? It means homes are more expensive even if the price tag isn't changing. Take this example. If you bought a home with a $300,000 mortgage back in 2021 at a 3% rate, your monthly payment would have been around $1,265. In 2024, with a 7% interest rate, the monthly payment for the same home is now over $1,900, a jump of nearly $700 every month. These higher payments impact all types of buyers: first-timers, families looking to upsize, and folks needing to refinance. Rising rates make it harder to adjust as life changes, which means we're all feeling a bit stuck. Now, let's talk strategy. If you're in the market or considering refinancing, here's what you can do. One option is going for an adjustable rate mortgage, ARM. Instead of a fixed rate, you get a lower initial rate for a few years. After that, the rate can go up, so it's a bit of a gamble, but it's a viable option if you're only planning to stay in the home short term. Another strategy is saving for a bigger down payment. The more you put down, the less you'll owe overall, which means lower monthly payments, even with high interest rates. You could also consider buying points. Each point costs about 1% of your loan amount and reduces your interest rate, which can make a big difference if you plan to stay in your home for a long time. Or you could wait it out. If you're not in a rush, there's always a chance rates could drop down the line. If inflation cools off, the Fed might ease up on rates. But remember, housing prices are climbing in a lot of places, so it's a bit of a trade-off. You could wait for better rates, but end up paying more for the house itself. With elections coming up, what each candidate does, or says they'll do, could affect mortgage rates, so here's a quick look at where Trump and Kamala Harris stand on the subject. Trump's take: he's long been vocal about supporting lower interest rates and may push for policies to reduce them. Trump argues that higher rates hold back economic growth and limit affordability for American families. He's more likely to back measures that get mortgage rates down quickly, which could make it easier for first-time buyers to afford homes again. If Trump has his way, we might see policies aimed at bringing down costs across the board, whether that means pressuring the Fed to keep rates low or introducing new tax breaks for homebuyers. Kamala Harris's approach: she has taken a stance focused on affordable housing and economic equity. Harris is known for supporting expanded assistance programs for first-time homebuyers and advocating for solutions that target affordability. She's likely to push for policies that help those impacted most by rising rates, potentially through direct support or incentive programs. This could mean new federal assistance for down payments, or even subsidies that offset high mortgage rates for lower-income buyers. If Harris and her party take the lead, expect a focus on making housing more accessible to a wider range of people, even if that means waiting a bit longer for inflation to cool. Both parties, meanwhile, have something in common. They recognize that the limited supply of housing is part of the mortgage rate issue. More homes on the market could mean less competition and potentially lower prices. So, both sides are interested in incentivizing more construction and tackling housing shortages. To sum it all up, 2024's mortgage rates are definitely changing the game, but you're not out of options. If you're in the market or thinking about refinancing, now's the time to get strategic and stay informed. Look into all loan types, weigh the pros and cons, and keep an eye on political developments as they unfold. Thanks for watching. If this video helped, make sure to hit that like button, subscribe for more financial insights, and drop a comment below if you've been navigating the mortgage world yourself. We'd love to hear your thoughts. Good luck out there, and see you in the next video.